Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG. Thought we would come to you today with a brief market update, kind of let you know what's going on out there. It is CPI day. Super exciting. The S&P 500 right at about 5270 for a level. That is up about 11% year to date, which is also an all-time high for that particular index. 10-year Treasury at 4.4%. That is down a little bit today in terms of yield due to that CPI report, which we will talk about in a moment. That's down about 30 basis points or 0.3% since the end of April. So long-term Treasury rates have kind of cooled off a little bit over the course of the past couple of weeks, which is one of the reasons why the S&P 500 has done fairly well, is this idea of cooling or moderating inflation. Those April CPI numbers that came out this morning, right at about 0.3% month over month for both all items and for core items. So however you want to look at that metric, we prefer to look at the core, up about 0.3% month over month, which is an interesting reading in the sense that still higher than where we need to be. We still need to be to sort of meet that Fed target somewhere in the range of 0.1 to 0.2% month over month. However, it's a better reading than what we saw in the first 3 months of the year. When those numbers were really closer to about 0.4% year over year. It is also the first reading in about 4 months that came in line with expectations, so not hotter than what people were thinking. All of the previous monthly inflation reports were actually a little bit higher than what people were looking for. This one's more in line. And so as a result, you're seeing a little bit of the tiniest relief rally in the marketplace of like, okay, at least things are behaving as expected. It's still too hot. Year over year inflation is running about 3.6% year over year annualized. And that's still above the Fed target. It's the lowest rate since April of 21, but still above where the Fed wants to be. I think you're just seeing the market rally a little bit because these numbers are in line with expectations. They're predictable and they're slightly lower than what we had in the prior couple of months. And indeed, Powell came out in testimony yesterday and basically said that he still expects that the next move on interest rates is down, that we will be cutting rates as the Fed's next move. But he did caution that they may have to stay elevated a lot longer than we initially anticipated based on the sort of inflation data that we've seen kind of year to date. I would generally agree with him. The market now looking for the first cut in the sort of September, November timeframe. We'll just have to see whether or not that comes to pass or not. But at least for this particular report, I would say a number that's kind of in line with where we thought it was, moving in the right direction, but not quite out of the woods yet on inflation, and the market kind of treating it as such. Would also be remiss if we didn't mention earnings. We are about mostly done with first quarter earnings season, about 460 companies reporting so far. Net earnings coming in up about 5.4% year over year for the first quarter. Revenue up about 3.8%. Those are both ahead of expectations. Expectations coming into the quarter were about plus 3% for earnings and revenue. Would just note that it's a beat, but it's an expected beat. If we go back and look at the history of earnings season, most of the time companies outperform, and this earnings season is kind of no different. So companies doing well, not a miss by any imagination, but nothing that I think gets the market super, super excited. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I will talk to you again soon.